Today I'm going to talk about inflation and the Fed. I'm going to get different points of view because what's happening is the inflation is not coming down at the rate that people thought, and actually in some sectors inflation is strong and even going up. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is February 21st, 2023. I'm going to begin with an interview that Joe Kernan does with Gunjan Banerji from the Wall Street Journal, and she talks about the risk that's in the market and that how this is different than 2020 and 2021. She believes, I'll just kind of paraphrase, that we are not headed into a growth environment. And the reason for that is bond yields. Bond yields are high. There's other headwinds, namely the Fed. And so January and early February, she believes, have gotten ahead of the market has gotten ahead of itself, and that there's a correction in front of us. Joe Kernan, as he's introducing her, says, this is interesting to hear from him because I've never heard him say this before. He said, I'm worried for the future. And then he introduces her, and she talks about her comment about the view of, from her view as a Wall Street Journal journalist. So take a listen to Gunjan Banerji.
Just over a half hour till the final opening bell of the week on Wall Street. But Gunjan, there is a Monday coming with there. That's
holiday. Oh, I thought you were going to say the market open.
No, I want to say there's a holiday coming. No, that's the good part of it. Gunjan Banerji is lead writer for the Wall Street Journal's live markets coverage. She's also a CNBC contributor. Let's talk about the markets. We just had a really weird segment. I don't know if you were watching it, Gunjan. I have never done this chat GPT type stuff, but I'm afraid of the future suddenly. And it's not just about the stock market. Tell me where we are at this point in time in your view. We were doing well in 2023. Now I'm questioning everything. Should I?
What a strange start to the year it's been. Bitcoin is back above 25,000. We've seen a frenzy in the options market that's reminiscent of what we saw in 2020, 2021. Some of the most speculative corners of the market are soaring. And I've had traders say to me, look, this feels like the pandemic market again of 2020. But the main difference is that bond yields are much higher this time around. And I think that's making a lot of investors question this rally because as we saw last year when bond yields rose, that weighed on the stock market. And that divergence has kind of broken down lately. And I think that's one of the biggest things to watch in trading today and after the holiday weekend is how is the stock market reacting to those higher bond yields? Or is it coming to terms with that? And maybe we do see a little bit more of a sell-off.
There's at 330 or 340, and you say, well, yeah, we could go back to 4%. That's one thing when you say it there. But when you're at 390 or getting close to 4, then you start thinking maybe it could go to 4.5. Maybe it could go to 5. And that might be a whole new issue for the market to try to digest at this point. Is that where we are?
Definitely. Joe, look, I think this concept of a Fed pivot, which really seemed to save the market early in the year, it's gone poof. Investors have repriced their expectations of that terminal rate significantly. And I think this week was just such a big wake-up call for investors. When you look at, we got 2 inflation data releases that were both hotter than expected. And I think that's really quashing some of those hopes that inflation will just go down in this super even straight line. And, that had buttressed the market earlier in the year. And I think a lot of people are questioning that right now. And that's what we saw in trading yesterday. And, ahead of the opening bell, it looks like what we're seeing again today with the NASDAQ underperforming some of those other indexes.
Scott Wapner interviews next Liz Young from SoFi. And she also feels that the market has gotten ahead of itself and that there is a correction in front of us. Her reason, though, is a little different. She believes that the consumer is running out of money, running out of savings, and has actually started to accumulate quite a bit of credit card debt. And the data actually supports that. And because of that, she sees that from the consumer side that the market is going to have some headwinds and is in for a correction. I would stay away from the word crash. I don't think at this point we're heading into a crash, but I think there is going to be a pullback. And for those people who have gotten on in January or early February, gotten on board with the market because it looks like it's going up, again, I think the market is going to give a number of people a head fake. And if these people are right, I would say probably in the next month or two. So take a listen to Liz Young.
Consumer piling up debt, the market piling up gains this year, and all of it happening while the Fed is piling up rate hikes and is likely to do even more. Does something have to give? It's the key question. Let's ask Liz Young, SoFi's head of investment strategy. She's right here with me at Post 9. This speaks to, welcome back. It speaks to the don't fight the Fed versus don't fight the tape. You know, Mester's out today saying, yeah, I would have done 50. Bullard, who's not a voter, but still says, 50 may be needed. What do you make of all this now?
Well, you know what's funny is that if you rewind about a month ago, the market was behind the Fed. The market was saying we're only going to get up to 5, and then we cut a couple times before the end of the year, and the Fed continued to say, no, we're getting above 5, we're going to hold it there. And now here we are. The market finally agrees. So it's almost as if the bond market, the futures have agreed with the Fed. They listen. The equity market, in my opinion, is still not quite listening. And
so
a lot of that.
You think it's in denial? The equity market's in denial?
No, I don't think the equity market's in denial. I think the equity market is listening to the data about the consumer that's concurrent, right? Mm-hmm. That there's retail spending that bounced back, that consumer confidence bounced back, and that services PMI bounced back out of contraction. There are things to be happy about. The labor market is still tight, right? But what I think the equity market is not pricing in at this point, or is not worried enough about, is that the consumer spending, at some point, savings run dry. And wage growth is falling. It can't support that level of spending going forward.
Well, did you see the New York Fed number today about debt, right? Debt's piling up, credit card usage is piling up, delinquencies are increasing. Is that worrisome to you?
Absolutely.
That's like a signal that, okay, this can only last for so long.
Of course.
This consumer strength.
Yeah, and I question some of the narrative around we've got all this pent-up savings. Everybody's sort of sitting on these stockpiles of cash. Well, the savings rate fell below 3%. We're at lows in the savings rate. If all the spending is happening on credit cards in a time when credit card rates are higher than they've been in decades, that's a problem. And at some point, people will run out of money. They're not worried about running out of it yet because they all still have jobs. Mm-hmm. And it's easy to find a new job, and wage growth is hot. But the PPI numbers today, too, did not give me a lot of confidence that inflation is going to continue to come down at the same clip that it has been coming down. I think that's another thing that the equity market is hanging its hat on, saying that, look, it's going well, it's going to continue going well until we get to target, and then we all sort of live happily ever after. And I just don't think it's quite that easy.
Next, I want to play a piece where Jonathan Ferro at Bloomberg is interviewing Mohamed El-Erian. And I play a lot from Mohamed El-Erian because he's so insightful, so smart, and he sees things sometimes that other people don't see. And it's interesting about his view on inflation. Inflation, as reported by the Consumer Price Index, the CPI, has come down from 8.5% to 9%, down to 6.5%. Okay, that's a ways, and that's the result of the Fed, primarily the Fed doing raising interest rates, called tightening. Now, Chairman Powell is saying, and he's been saying this for some time, that he wants inflation down to its long-term number of around 2%. He's been very firm about that for many months, 2%. What's interesting is Mohamed El-Erian is saying that he thinks that there will be a shift in policy, a shift in thinking and rhetoric by the Fed and Chairman Powell. He thinks they will settle for 3 to 4% inflation and not go to 2. Well, to get down to 3 to 4, or certainly to go down to 2, is going to require more rate hikes. We know that. Probably 2 and probably 3. But his inference is that may get us, may or may not get us even down to 3 to 4. And when he says 3 to 4, I'm translating that as 4, because 3 is a long ways from 5.5 when you start moving the economy that much, that quickly. So in my opinion, that's doubtful. So, but even if he's right, there are a couple of problems. First of all, to get from 6.5 to 3 to 4, let's just say 4, that's going to require a lot, which means that the economy is not done contracting. I mean, there is a lot of contraction left. They're calling it put the brakes on the economy, and of course that's going to mean probably the stock market as well. So, but the other thing about 3 to 4% is if they settle for that, for the first time in a long time, I don't know when this has been true, we as a country, we as an economy are going to get stuck with high inflation. And 3 to 4% long term is high. And so that's going to be, it's going to rip returns out of savings and fixed income people. Their financial plans, nothing is built on 3 to 4%, or at least not very much. Most people are assuming 2, or they may say 2 to 3. But settling for higher inflation because the Fed doesn't want to crash the economy any more than it's already going to crash it, it's an interesting perspective. But I won't say I disagree with him because that could easily happen, but it would require Chairman Powell coming out with different kind of statements than to make a shift in his thinking than he has been saying for a long time. So we'll see how that plays out. But I thought you'd find this interesting from Mohamed El-Erian and Jonathan Ferro.
Do you really believe that they can get CPI back down towards 2% without getting unemployment through 5?
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, an energy transition, a change in the supply chains, geopolitical issues that come onto the supply side, the way the labor market functions. It's a long list of supply issues. You need a higher stable inflation rate, call it 3 to 4%, to allow for the lubrication that's necessary for these changes on the supply side. But you know what, John, you heard me say this when I was with you last time. You can't change an inflation target when you've missed it in such a big way.
Well, you can't change the target, but maybe you can tolerate an above target inflation rate and just tolerate it, Mohamed. Now, you've mentioned that a couple of times now, and I'm picking up on it.
I think that's where we're going to end up. We're going to end up.
You think that's where we go?
That is where I hope to go, and I hope that that's a stable world, John.
Next, I'm going to play a piece from where David Westin, Bloomberg, is interviewing Larry Summers, a former Treasury Secretary and professor of economics at Harvard. He also has a little different take on the inflation question. And last couple of weeks, I played pieces from Felix Zulauf, and Felix Zulauf made the point of that, implying that they're going to keep tightening until something breaks. He called it a credit event. That's nice. Those are nice words for a bankruptcy or a series of bankruptcies, and those could be countries or corporations. What Larry Summers is saying, until something breaks, kind of similar to what Felix Zulauf said. And so anyway, it's an interesting perspective. I thought I give a lot of credibility to Larry Summers. So I think you'll find this also a different angle, but saying somewhat the same thing. Take a listen.
So, Larry, it was quite a week this week for economic numbers. Certainly in the United States, we had the CPI numbers, we had the PPI numbers, we also had retail sales numbers. And what I took away from it is, you know what, we're not close to a recession, that's for sure. On the other hand, that inflation is not coming down very fast. Do we need to rethink exactly what we're doing as we try to approach inflation?
David, here's how I think about it. The Fed's been trying to put the brakes on, and it doesn't look like the brakes are getting much traction. And when your brakes don't get much traction, two things happen. You can be moving too fast, that's the inflation pressure, and you can be setting yourself up for some kind of collision or crash down the road. And both of those things, I think, are real risks in this environment. We clearly have an economy where demand is super strong, the highest ratio of vacancies to unemployment we've ever seen, retail sales on fire, the economy creating jobs faster right now than population growth by a factor of 5 in the latest month. If you look at the broadest measures of inflation, the median inflation component at its highest rate in 40 years, running close to 7%, a general broadening of price pressures. So that has got to cause real concern about inflation. It's got to at least raise a question about the paradigm market observers have had of how many 25 basis point increases before the long pause and move towards decrease. It raises the possibility that we're not landing at a terminal rate sometime in the next several months, or that we're going to have to go back to hitting the brakes harder by more than 25 basis points. At the same time, the Fed has to be very careful. I don't think those who think inflation is slowing, therefore it's obvious that we've got to hit the brakes very hard, necessarily are right, because if you look at accumulations of inventories, if you look at what's happened to the savings rate, if you look at how many firms have built up their payrolls, if you look at signs of a bit of euphoria coming back into some stock markets, you also have the possibility of that Wile E. Coyote moment that I've been referring to that could come, not next month, but could come sometime in the next few months.
Okay, now I'm going to shift gears slightly and go to a slide. This is a chart that I've shown several times, and this is updated through the month of January. And this is the historical chart of the S&P 500, the historical composite for 150 years from 1871 to present. It's inflation adjusted, and it is on a logarithmic chart. So it's very realistic as far as depicting what the market, the S&P, has done. We typically don't look at logarithmic charts, and we certainly don't look at inflation adjusted charts. So this is adjusted for both. You'll see blue lines, which are bull markets, and red lines, which are bear markets, down markets. And you'll see that there are 4 down markets, and there are 5 bull markets, up markets. At the very end, on the far right, is where we are today. As that goes up, and then it comes down a little, that's where we are through the month of January. And there's a red regression line that cuts through the data, or through the chart. You will see that invariably, when you have a bull market, it goes from the bottom up through that regression line to a high point. And we are now at a higher point than we have ever been for the S&P 500 when adjusted for inflation. So when it comes down, it has got to come all the way down to the regression line, and all of the time, every time, it has gone below the regression line, because part of the data is below the line, part of the data is above the line. So that typically is what happened. Now we're at this elevated point in the data, or in the S&P 500, measuring the market, and you can see the drop that has occurred, and that would be, I'll just call that 2022. So the year of 2022, let's just say that drop is the whole year. You can see how far it came down. Not much. Look how far it's got to go to get to the regression line, and every time in the past, it has gone past the regression line. And people, I'll just say Jim Rogers and many others, have said, when this comes down, this is going to be the mother of all crashes. It is, and I don't think that's right in front of us, but I do think that this tick down does not represent an adjustment and then it will go back up. It will make its move down. If it's like the past, as you can see, it'll make its move down. It'll try to go up and then it'll collapse. It'll try to go up and then it'll collapse. It does that over a series of years. And I would say that the range of these years for bear markets, the shortest period is 9 years, the longest period is 20. So let's just say about 15 years on average that bear markets tend to last. If the 2022 is the beginning of a bear market, and I think it is, that blue line that ticks down will eventually turn red because it will have marked the beginning of a bear market, if I'm correct. But it's not going to happen in a year or 2 or 5. It may not even happen in 10. I would say 10 to 15 years it's probably going to take to play itself out. So it looks to me that we are headed into an environment, not just for the next month or for this year, but for many years where there is going to be a headwind. You can call it interest rates, inflation, supply chain, general economic slowdown conditions, whatever you want to call it. There will be numerous things that will be brakes that will be put on the economy that will not create an environment for growth. Eventually what happens in all of these cases, what has happened in the past, is it gets to a point of exhaustion, the market drops so far, and the economy is in such shambles that then it is ready to grow. And then it is ready for the next bull market. And I think that will happen, but it's not yet. So those people who are trying to be optimistic and put a happy face on this, that, just stay invested, it's going to get better, or, whatever you want to say about it, I don't share that opinion. I don't think it's correct. And a lot of people that I listen to don't think it's correct. The one who I've quoted before is Russell Napier, who's probably the best financial historian in the world. And he says 10 to 15 years. But I just wanted to give you that perspective of where we are from a macro perspective. Now, we've been talking about 2023 from the interviews I've been playing, but it does go beyond that. Okay, this last week, there were a couple of, we've come through a couple of reports. We've had the producer price index called the PPI, and it was quite positive. Now, when I say positive, that means negative. Let me explain. So the producer prices are higher. And what that means is, and that's represented for the month of January by that red line at the end of the chart. As producer prices are high, what that means is inflation is not coming down. As a matter of fact, it's going up, according to this. This is producers, those who produce goods. Now, the consumer is the same thing. The consumer is up. This is just a 1 month picture. It's, a half of 1%. The inflation, the consumer price index is at about 6.5%. But you can see from the producer side and from the consumer side, prices are stubbornly elevated. So when there are areas where inflation is probably coming down, energy, gas prices being one of them, but and home prices are starting to soften. But many elements that people are dealing with as far as things that we typically purchase are not coming down, which is why these the CPI and the PPI are stubbornly high. This shows retail sales have been strong. So I consider this a paradox. So here we have high inflation. The Fed is trying to put the brakes on it, raising interest rates, and the consumer is spending. Look at the last bar. It breaks it down as to where it's going, but you can see the strength in the retail sector. And that's kind of a paradox. Here we are looking at that would normally spell a good economy. And yet we've got all kind of indications that we're heading into trouble, and consumers are not getting the memo. They are keeping on spending. So when you hear some of these things like this, you think, this doesn't add up, but that's what the data says. This next slide shows another picture on retail sales. The black line just shows retail sales. You can see where they're going this is measured in billions, so $700 billion. But when you pull out the goods CPI and look at the real retail number, that's represented by the blue line. So retail sales look like they're going up, but underneath it, there is trouble as represented by the blue line. Then getting away from that, going over into the manufacturing sector, this is the Philadelphia Fed, and they report on the manufacturing index. And you can see the degree to which, at the far right of the chart, the manufacturing component is down. What's interesting is it was projected to be down 7.5%. It is down 24.3% for the month of February. So it is a lot weaker on the manufacturing sector than was even expected. Now, I want to play a short piece. Morgan Brennan from CNBC is interviewing Daan Struyven from Goldman Sachs, and she's asked him the question of where do you think oil prices are going? And it's an interesting answer. He talks about China and what that's going to have, the impact he thinks that's going to have in 2023, both by the summer and the end of the year. And I think a lot of projections that oil prices have been coming down do not bake this into their future assumptions. So take a listen, and then I'll comment after the video.
So that's exactly right. So I think, since the November oil market sell-off, oil prices have been range bound and have sort of been caught between relatively soft spot fundamentals and an improving macro outlook, and especially an improving outlook for China demand. And so we think that China reopening will be the game changer for oil prices this year, and is the main reason why Brent prices, we think, should start to exceed $90 per barrel in the summer, in June, and reach $100 per barrel by the end of this year, as the return of China should really push markets back into a deficit.
So you picked up on this. The oil prices are, he believes, headed to $90 by the summer and $100 a barrel by the end of the year. Why? China. China has reopened, and that I don't think is factored into the assumptions. The amount of energy, the amount of oil that they use is significant, and opening up will have an impact on that. So next I'll give you the flow of funds report. And it's interesting. This kind of shows what I've been talking about. Money is going today, at this point in the last week or so, money is going out of equity funds and into bonds and money market. So, and there are trillions, so this is not a big number. It's a fraction of a percent, but it shows in general the direction that money is flowing. The outflow of money out of equity funds is $6.3 billion. The inflows into bond funds is $9.6 billion, and into money market funds is $10 billion. It tells you that to some degree, small degree, that there's a concern about the direction of the market. Now I want to show you this. Now I've told you before, I don't have a TV. I got rid of my TVs, but I do read the news. I read it on the internet, and most people tell me they have TVs, so I understand that. You've seen these pictures, so I'm not going to spend a lot of time on it because it's already been quite well reported, of the train derailment in Ohio. After the derailment, they blew up the cars, which created the explosion and the toxic, fumes into the air and the water and the earth and everything. So, but I'm bringing this up. I'm going to come around it a little bit. So just bear with me while I go through this. But this triggered a thought in my mind that things are kind of wonky in the world. They're kind of weird. This struck me. It's a tragedy and it's horrific. But it struck me as, I'm suspicious. I don't tend to buy everything that I hear. So it struck me, the whole thing, the way it came down is odd. The tragedy itself is bad. But I just don't quite get my brain around the idea that, this was just a random accident. I don't want to go any further than that. It just raised a question. And then my mind began to think of other things that seem weird to me. And so I thought I'd put these pictures up. So there's a picture in the upper left of the Ohio small town. And I've covered this before. In the upper right, the number of food processing plants that have had random explosions, lots and lots of them. And there are chicken farms and all over the country. So between chicken farms and the food processing plants, I think I reported there are about 100 that have had explosions or fires and been destroyed. That to me seems weird. I don't know. I don't want to speculate. It's just, it doesn't seem right to me. And then at the lower left, I don't keep track of this, but have you noticed that the number of people who are dying, who are athletes, young athletes who are dying on the field, perfectly fit, never had any health problems, and they drop dead? It seems like every day I'm reading about this. And other people who are not old people, they're not necessarily athletes, but they just are dropping dead. That seems weird to me. And then we have these balloons flying over our country. Does that seem weird? I don't know what that's about. But you know what? The information that we're getting from the government, I got to tell you, I don't trust it. It just doesn't seem right to me. I think there's stuff going on that I don't understand, and I'm probably never going to know what this is. But I just wanted to report this and just say, do you think that? Are you suspicious that all of this is just the way it's supposed to be? It just doesn't seem like it's ever been like that before. When I come back, I'm going to bring it all the way back to the stock market, which is what I talk about. And as I showed you this chart on the cycles of the stock market, and you could remember looking at that chart where there was this tick down at the end of the chart, which is where we are now. What it's going to take for the market to go up is a growth economy. If you have underneath the market, you have a growth economy, the market will grow. We do not, these images are just an example of what I look at and say, if the Fed isn't enough to put the brakes on the economy, things like this cause me to be more cautious, more reluctant to say, we're in a growth economy and I'm going to just put my money in the market and let it go. That I don't know how other people feel, but if there are enough people that feel that way, then there's reluctance. Then the market has got to work itself down until all of this, whatever is negative out there that's putting a headwind on the economy, works itself through the system. And while I do think the market is eventually going to go up, I don't believe we're there yet. I've been talking about the Fed, and I think of the Fed, I saw this cartoon, I think of the Fed as being the elite people, the powerful people, and they're doing to the economy, positive and negative things to stimulate the economy or slow it down, et cetera. And then there are the average people like you and me, who are paying their bills, running their households, all the things that most people do. and it's a dichotomy. It's a world of two realities: the Fed and the Fed up. So I couldn't resist showing you this. Thank you for watching. If you have comments or questions, leave them in the comment section below. Thank you again.